Well, hello, everyone. Cynthia Tomaine here with Interactive Brokers, and thank you for joining today's presentation on the Introduction to Technical Analysis and Recognia. Now, with us this afternoon, I'm very pleased to have Peter Ashton. Peter, who is the Vice President of Recognia, will be delivering today's event. Now, also want to point out that Peter, let me get my notes up here. Okay, do want to introduce Peter Ashton, who is going to be speaking to us today and explore the underlying principles of technical analysis and how you can apply that to your trading. Peter will describe major classes of technical events and how Recognia automates the detection of these events to identify potential trade ideas. We'll also be jumping into the IB Trader Workstation to demonstrate how to use Recognia to evaluate trade ideas and the technical perspective of any stock or ETF. So would everyone please join me in welcoming Peter Ashton. Now, Peter, I'm going to put this over on your slide, but I'll also be passing the ball over to you. So if you can unmute your phone, I see you already have. Excellent. Let's give you the control. And thank you for joining us, Peter.
Well, thank you very much, Cynthia. It's a pleasure to be here. Welcome, everyone, to this webinar entitled Introduction to Technical Analysis and Recognia. So the agenda we'll cover in today's presentation is a very quick introduction to Recognia and who we are. And we'll start talking a little bit about an introduction to technical analysis. And we'll talk a bit about the history of technical analysis, where it came from. And we'll lead into the three major classes of technical events that are used in modern technical analysis today. We'll give you some real live examples of each of those classes of events. And we're going to finish up our presentation with a live demo on the Interactive Brokers Trader Workstation to show you where you can find access to Recognia content and how you can use it and make it a part of your everyday trading workflow. At last, we'll take the questions and answers at the end of the presentation, and hopefully we'll have some good questions to deal with. Very quick disclaimer before I begin, just to say we're going to talk about some specific examples of stocks as part of today's presentation. And all these examples are provided for illustrative purposes only. None of the information in this presentation is intended to constitute a recommendation by Recognia to buy, sell, or hold any stock, option, or securities. So very quickly, who is Recognia? We are a provider of technical, fundamental, and quantitative research, mainly at retail online investors and traders. And we seek in our products to help automate the investment decision-making process such that you can cover more ground than you'd be able to do on your own. I've been at this for over 15 years, and we're solely focused on the needs of self-directed investors and traders. And you can see we've won a number of awards for our products. So let's begin by talking about what is technical analysis. So at its core, technical analysis is all about looking for patterns in the price and volume histories of stocks or securities of other kinds that can tell us something about the attitudes of buyers and sellers. And if we think about every single share that trades on an exchange, that trade represents an agreement between a buyer and a seller for what is the fair price of that security at that moment in time. And that fair price reflects everything that's publicly known about that security, reflects the fundamentals, reflects the news, reflects the general market sentiment about that sector of the market or that stock in general. So by following the changing balance of price, it tells us something about the shifting balance of price and demand for that stock in the marketplace. And that can help us to make better investment and trading decisions. Many people are surprised to find out that technical analysis is not something new. It's actually been around for about 400 years. It actually originated in the rice markets of Japan. And in fact, many of the names of events that we use in technical analysis today, names like doji, those actually come from Japanese. But modern technical analysis, like we practice today, really dates back to Charles Dow. This is the same Dow we know from the Dow Jones Industrial Average. He's the very first editor of the Wall Street Journal. And Charles Dow observed the markets back in the late 1800s, and he believed that he saw cycles. And he named those cycles the primary trend, which was the longest term cycle. There was an intermediate term trend that was superimposed on top of the primary trend. And then smallest of all, there was a short-term trend further superimposed again. And what's very important is that in some places, like right here, all of those trends are moving in the same direction. They're all moving upward. Whereas other places, like right here, well, we have the intermediate trend and the short-term trend moving up, but the primary trend moving down. So to make good investing and trading decisions, we need to understand where we are in each of these three trends. And that's one of the principles of modern technical analysis. Now, many of you may come away from this presentation with a desire to learn more about technical analysis, and if you do, I really very highly recommend this book called Technical Analysis of Stock Trends by Edwards and McGee. This book actually came out back in the 1950s, and it's as close as there is to a Bible of technical analysis today. So everything that I talk about in this presentation, you'll be able to find in this book. But I wanted to use a key quote from the book to talk about why it is that technicians study the price to the exclusion of everything else. And Edwards and McGee said that the market price reflects the hopes and fears and guesses and moods, rational and irrational, of hundreds of potential buyers and sellers. Price is the only figure that counts. So again, this reflects the belief of technicians that by studying the price, you're also studying all the things that go into deriving that price that might include the news, the fundamentals, the market sentiment, and so on. Now let's look at a quick example. So here's a stock price chart for a real stock, and kind of has a very interesting price history. You notice it's kind of moving sideways for a number of weeks here on the left-hand side of the price chart, nothing much happening. It goes on a huge rally up to about $20, big decline down to about $9, big rally up to $20, declines again, kind of consolidates in this price range here, kind of in the the $7 to $12 range for a number of weeks, before finally going on a huge tear and running up to about $30 in just a matter of a few weeks. Well, wouldn't it have been nice to know that this consolidation period here represented an ideal opportunity for you to be building your position in this particular stock? Well, how would we know that? Well, technicians would say you'd know that because there was a particular pattern that formed over this period of time. That pattern is called a head and shoulders bottom. And this is a head and shoulders bottom. It's an upside down head and shoulders. So imagine this was turned around. This would be the left shoulder. This is the head, and this is the right shoulder. And the head and shoulders bottom is a bullish reversal pattern. It tells us that the previous trend is likely to reverse and the price is going to move higher. So here's the previous trend, which is downward. We then had the price rally and decline, and rally again. And on that third rally, it broke across this horizontal red line. And that red line is called the neckline. The neckline represents a level of resistance to the price of the stock. Notice we bounced off that neckline twice before we actually broke through on the third attempt. So where we broke through on that third attempt, that indicates the start of a new bullish trend. Now, technicians, of course, over time have defined lots and lots of different kinds of patterns and events like the one I just showed you. And at Recognia, we group those into three major categories. We call them short-term patterns, which are based on the shape and relationship of candlesticks or price bars. They're indicators and oscillators, and they're classic patterns. Let's just take a minute and we'll look at a couple of examples of each of these different classes of events. Let's start off with a very common short-term pattern called the hammer. So here in this purple circle, you see I've drawn an example of a hammer. So this candlestick, you can see why it's called a hammer. It kind of looks like a hammer. It has a hammer head on top and it has a long handle coming down. And the hammer, like the head and shoulders bottom, is a bullish reversal pattern. It tells us the previous trend is likely to reverse. Well, what's the previous trend? Well, this particular stock has been declining over a number of weeks. So what happened on the day that this hammer occurred? Well, what happened was we actually opened right at the high of the day. The stock immediately traded much, much lower, but then something happened during the course of the day that caused it to reverse and start to move higher. And in fact, it actually closed back right near the highs of the day. What does that tell us about the sentiment of traders on this day? Well, they started the day very, very bearish, and why wouldn't they? The stock has been declining over a number of weeks. The stock is immediately taken much, much lower, but something happens during the course of the day to cause them to change their mind, decide they're much more bullish on the stock, and the stock actually finishes back near the highs of the day. Now, in this particular example, you notice the stock did go on to rally, in fact, and had a significant rally following the occurrence of this pattern. Now, of course, the challenge in trading patterns like a hammer is you don't get the benefit of seeing what happens next, like I've drawn it on the chart. So how do you trade something like this? Well, a couple of thoughts for you. First of all, if you are perhaps a conservative investor or trader, what you might want to do is watch the price of the stock over a number of days following the occurrence of a pattern like a hammer. If that reversal becomes is seen, then you can actually decide, okay, now I believe the hammer is actually causing a reversal. Let's go on and let's get our position in this particular stock. If you are more aggressive, what you might decide to do is buy the stock immediately upon occurrence of a stock, like a pattern like a hammer. But you're going to want to make sure in that case that you actually have a stop loss in place a little below where you bought it, such that you're not going to lose your capital in the event that the price happens to go in the opposite direction than you expect. I'll give you another example of a short-term pattern. This is called the shooting star. And the shooting star is the bearish counterpart of the hammer. I've actually got a couple of other examples of hammers down here at the bottom, but I have two shooting stars shown, one here on the left-hand side of the chart and one on the right-hand side. And the shooting star is characterized by a very small real body, like you see right here, and the real body can be either black or white, doesn't make a difference. And we have a long, long tail, just like the hammer, we have a long tail coming out from behind it. Now, I'll often ask people when I give these presentations in person, which one of these two shooting stars is the better example? Well, I actually like the one on the right-hand side better for two reasons. Number one is the tail is much, much longer. That indicates to me a larger reversal in sentiment, and that's what we're looking for in the case of a reversal pattern like this. Second of all, the shooting star on the right comes at the end of a long uptrend. And these reversal patterns tend to work better when there's something to reverse. The shooting star on the right tends to come at the end of a sideways period. So it's not quite as good an example of a shooting star. But notice in this particular case, the price did reverse lower after our shooting star on the right, and is in the process of starting to reverse lower in the one on the left. So that's a couple of examples of short-term patterns. And let's now talk about another kind of technical event called indicators and oscillators. And these are probably the best known kind of technical analysis events. They're based on moving averages and other kinds of mathematical functions. The reason why they're the best known is not because they work the best, it's because they're very easy to calculate. So even in the days before computers, people used to calculate things like moving averages. So today, just about every charting package has all kinds of indicators and oscillators in it because they're easy to calculate, whereas the short-term patterns and especially the classic patterns are very, very difficult to calculate, and that's why they're not found in as many places. So let's look at some indicators and oscillators, and these come in sort of three types. They're what are called trend-following indicators, and these are indicators that work to basically smooth the price so that trends can be easily seen. So they kind of take out some of the noise so you can see what the overall trend is. And moving averages are a very good example of a trend-following indicator. There are indicators and oscillators called momentum oscillators, and these are basically used to measure the speed or direction of price changes. And last, there are stochastics, which measure the position of the closing price relative to the recent highs and lows. These are all very common. So we talked about moving averages very briefly, and this is one of the most common types of indicators. And the simple moving average is defined very simply as the average price over the last n days. So if we're calculating the 50-day simple moving average, you just take the closing price over the last 50 days, add it up, divide by 50, that gives us today's value for the 50-day SMA. And technicians have also invented other kinds of moving averages like exponential moving averages and weighted moving averages, adaptive moving averages, and so on. And all of these tend to work best in trending markets. So markets that are moving sideways or have a lot of sort of sideways, a lot of noisy chatter in them, they don't work as well as moving averages do as in trending markets. And people often ask, why the different periods of moving averages? Why the 50-day or why the 21-day? Well, a lot of these are just historical and they're relative. So for example, a 200-day moving average was originally used in the commodities market because it was used to analyze the silver market. And 200 days was very significant because Kodak, who was the biggest consumer of silver in the world, used to keep a 200-day supply of silver on hand. In other commodities, soybeans, they used to use the 4-month moving average because that's the average shelf life of margarine. Here's a couple of examples of simple moving averages and how we could actually use them. So here we have two different simple moving averages drawn. The red one is the 200-day SMA, and the blue one is the 50-day. We could actually use these in two different ways. So the 200-day SMA basically forms a nice dynamic level of resistance to the price of the stock. So notice how many times we approach or touch that line before actually breaking through. Look how many places. So if we were to actually extend this price chart beyond the right-hand side of what is actually shown here, if the price was to approach that line again, we might expect it to bounce off the 200-day SMA rather than breaking through. On the other hand, if it was actually to break through the 200-day SMA, that would be a very bullish sign because a previous level of resistance has now been breached. Now, the 50-day SMA, we could actually use a different way. It actually forms a very nice trading signal for this particular stock. And in fact, if I draw on here where we cross the 50-day SMA in the upward direction with a green line, and where we cross in the downward direction with a red line, you could have used that as a very simple intermediate-term trading system. So we would buy where we cross in the upward direction right here. We'd profit from this uptrend here. We would sell short where we crossed in the downward direction, so we'd profit from this decline. We would buy here, sell short here, and so on. So you probably would have made money with that very, very simple trading system. And last, let's spend some time on the classic patterns. As I mentioned, these are probably the least known types of technical events because they're the hardest to calculate. In fact, these are things that typically only human analysts used to be able to do. But we'll look at an example. Let's take a look at the head and shoulders bottom as an example again. So here again, we have a long downtrend leading into this particular pattern. And as we talked about before, the head and shoulders bottom is a bullish reversal pattern. So again, we had a decline and a rally, a decline and a rally, a decline and a rally, and that neckline that's broken on the third attempt, which forms the head and shoulders bottom. Now, it's important to note that we haven't got a head and shoulders bottom until we have that confirmation. Until you've broken that neckline, it's not a valid head and shoulders. So people will often do things in anticipation of patterns forming, but just purely from the perspective of technical analysis, it's not a head and shoulders bottom pattern until you've actually crossed that neckline. Now, I actually think that the classic patterns are perhaps the most actionable and the most useful kinds of technical events, and I'll tell you why. It's because unlike the other two kinds of events we talked about, classic patterns can tell us something about what may happen next. So technicians over time have developed some rules of thumb to derive a target price or an expected move from a classic pattern. So the way that that's done is we measure the height of the pattern. So in the case of a head and shoulders bottom like this, we're going to measure from the neckline to the lowest point of the head right here. And we're going to add that amount to the confirmation price. That gives us the expected move or the target price. What we can also do is we can measure the pattern duration. From the place where the price crossed the neckline in the downward direction to the place where we crossed it in the upward direction, that is the pattern duration. So we're going to add that pattern duration to the confirmation date, and that gives us a rough rule of thumb for how long we think it will take to reach the target price. So these are very, very actionable events because they tell us what may happen next and how long it may take to happen. So let's talk about some other examples of classic patterns, and I'll go very quickly through these. But a fairly rare kind of pattern, but a very useful one, is known as the triple bottom. And triple bottom is shown here. You can see it's a decline and a rally, a decline and a rally, decline and a rally, and breaking through the neckline on the third attempt. So very similar to the head and shoulders bottom, but all the declines are kind of at the same level. In all these examples, by the way, I'm going to show you the bullish pattern, but there's a bearish counterpart to that pattern as well. So we're showing you the triple bottom, which is the bullish pattern, but the bearish counterpart would be the triple top. Another very useful one and a much more common pattern is actually a double bottom. So very similar to the triple bottom, but we have only two rallies and declines like this and breaking through that neckline on the second attempt. And I actually had somebody ask me in one of these presentations a while back if it was true that all triple bottoms also contain double bottoms. And that is actually not the case. In fact, for this to be a double bottom, we have to break through that neckline. And once we've broken through the neckline, it can no longer be a triple bottom. So double bottoms and triple bottoms are completely separate, and there's no overlap between the two. Now, triangles are very, very common. There's tons and tons of examples of triangles all the time. That's because there's a number of different types of triangles. But what's common in all triangles is basically we have a lower level of support and an upper level of resistance, and the price basically oscillates between those two levels. And what's interesting is that support and resistance are actually converging. So there's an increasingly tight consensus between buyers and sellers for what the perspective is on this stock. Now, eventually that situation can't go on. So we're going to have to break out either above the upper level of resistance or below the lower level of support. That is what confirms the triangle pattern. So if you break out above, it's bullish, and if you break out below, it's going to be bearish. Wedges are extremely similar to triangles, but the difference is that rather than having the lower support level either horizontal or rising, it's actually declining. So it slants downward at a slight angle. Other than that, it's very, very similar. And incidentally, I forgot to explain this before, but you'll notice on all these examples, I've drawn this green rectangle. And this is what's known as the target price region. So remember we talked about how we derive a target price by measuring the pattern height. What we do is we're actually measuring the pattern height, and this dark green region here at the top, right where my mouse is, that is the target price. That's where we think the price is going to go. And then the width of this rectangle, that is the target price horizon, how long we think it's going to take to get there. So notice that in this example, we actually made it all the way to the target price in about half to 2/3 of the target price horizon. And flags and pennants are also very similar kinds of patterns. And a flag is actually a very interesting example. It's a nice way to get into a stock that's already had a very steep move. So for example, we have a very, very steep uptrend here in the price of this stock, and this is called the flagpole. And then the flag is a horizontal consolidation period. The price moves sideways or even sideways and down a little bit for a short period of time. And what will often happen at the end of a flag pattern is that the price will resume that very, very steep increase. So a flag can be a good opportunity to get into a stock that's already had a significant move. And then upside breakouts are also quite common. So again, here you have an upper level of resistance and a lower level of support, just like the triangle, and we seesaw back and forth between those until the market gets some direction and it breaks out either above or below. In this case, we broke out above. This is called an upside breakout. And the megaphone is, again, a fairly complicated, but and a fairly rare kind of pattern, but it's kind of interesting if you think about the psychology of it. So the megaphone is very similar to the triangle, except that rather than having support and resistance converging, support and resistance are actually diverging. They're getting further and further apart. This is an unusual situation, and basically it tells us this is a market that's kind of out of control. There is an increasing divergence between buyers and sellers for what is the fair price of this stock. Eventually, either buyers or sellers will get control of the market, and we're going to break out either above or below the megaphone, signaling the start of a new bullish or bearish trend. And then a diamond can be thought of as kind of just a combination of a megaphone and a triangle. So we actually have that diverging support and resistance at the start of the diamond, followed by a converging support and resistance at the end. And diamonds, believe it or not, are actually quite common. And there's several different kinds of diamonds, including the diamond bottom, diamond top, and bullish and bearish continuation diamonds. And last but not least, we'll talk about the rounded bottom or rounded top. And unlike the rest of our patterns where there's sort of a rapid takeover of either the bullish or bearish sentiment, in the case of the rounded bottom, sentiment changes very slowly over time. So in this example here, we're looking at a slow change in sentiment in this stock from bearishness to bullishness over about 6 months in the marketplace. And it's actually when the price crosses the moving average in the upward direction that signals the start of a new bullish trend. And many people are also familiar with a pattern called the cup and handle. Cup and handle is just a very special case of a rounded bottom. So every cup and handle has a rounded bottom in it. So your initial indication that a cup and handle is forming is actually the fact that a rounded bottom's taken place. So we've talked now for about 25 minutes, and I've given you, a few different examples of short-term patterns, of classic patterns, of indicators and oscillators. And many of you may be thinking at this point, well, it seems like an awful lot to learn, and how many of these things are there anyway? Well, in fact, there's lots and lots of different kinds of these patterns, and much more than what I've talked about in today's presentation. But the nice thing for you is that you don't have to worry about how to recognize all these different kinds of events, because Recognia does that for you. We automatically scan the market and look for over 60 different kinds of technical events, short-term patterns, classic chart patterns, indicators and oscillators, and we do that every day, not just on a handful of stocks, but on every single stock and ETF that trades. And that's across many, many countries in the world. So no matter what it is you're looking for analysis on, chances are Recognia has already done it for you. So we're going to do a transition and talk a little bit about how to use these tools using the Trader Workstation. I think Cynthia was going to take over at this point and actually show us where we can find Recognia in terms of subscribing to it on the Interactive Brokers site. Do you want to take it from here, Cynthia?
I certainly will, Peter. Thank you. And I'm going to grab the ball back for just a moment, and let's move right over into a desktop share so that you can see, based on your information where you can find Recognia via the Trader Workstation platform. Now notice here, I've logged into account management because this is your first stop to finding that information. If you go to the Manage Account tab, you'll find Trade Configuration, and then simply go to the Research tab. This is where you'll be able to find all of the research subscriptions that are available, and the same thing that Peter was just showing you in his screenshot there. Now notice here, as you come in, there is no charge for the basic research platform, but in order to take advantage of it, you'll find that we do include individual subscriptions. But with Recognia, it's actually included as part of the basic Research Essentials bundle that's available for Trader Workstation. Notice right down here at the bottom, you'll see the subscription to Recognia. So if you do subscribe, notice that it is available by different region, different global region. Make your selection here. I happen to have it set on North America for right now. But then I also want to take you into the Trader Workstation. Now notice I'm going to pull up our Mosaic interface, and you'll find at the very bottom of the left-hand side of your screen, there is a news window that's available. Different news providers can be accessed from here, and notice there is a market, portfolio, and then ticker-specific information. But you'll also find there is a plus icon that's included in the tab. Clicking on that tab will give you the ability to add an additional filtered feed, which I've already done here. And notice that with the RCG, that's showing you this is the Recognia information. Now, I do have it filtered to show me just what's available in Recognia. On any of the ticker symbols that or that you've accessed, you'll actually see this RCG. But if you do want access to just all of the Recognia events, notice here there's a configuration wrench. Going into that, you'll find the settings panel, and notice here, once you've added that additional filtered feed, it does open up with the general news articles. Now, there's quite a few that are available. So notice the first thing that I've done, while they were all selected, I deselected them from this screen and then chose just to show Recognia here. Once I click Apply and OK, you'll see all of today's events will appear over on the left-hand side of your screen. By the way, any of these, not only does it include the Recognia identifier, but it also identifies the ticker symbol. So if you're looking for something specific, notice clicking that title will bring you into the information where you can download it or review directly from here. Now I'm going to minimize this and also show you that any of the items that are included here, for example, if I do put, let's simply put KDR, notice that sorry about that. Let me put this in again. And here is where you'll be able to find, I'm going to go, okay, I may have the wrong stock, but for any of these ticker symbols, you can find the same information on an individual ticker if you do go over to the ticker-specific window. Notice here, KDR I've got, and here you'll find all of the different identifiers. Now, also what I'm going to do is take us back over into the main event window because well, wait a minute. Let me go back to our website for a quick second here. I'm simply going to go into the Interactive Broker website because there's more information available that will give you access to those reports. Notice the search field. If you simply type Recognia up here and then click Go, you do have to spell it correctly, so let's do this one more time. And notice there is a specific page that's available for you. I'll be putting this hyperlink into the chat panel in just a moment, but I did want you to see that once we do go in and access, you can find additional information on Recognia, view a sample report, and even access the Recognia website directly from this page. So we're trying to give you lots of different ways that you can access Recognia information via TWS. Now, let's move right back over. I'm going to stop my desktop share now, and I'd like to take it back into the main event window because if you do have any questions, now's the time to put those into the chat panel. So, Peter, back to you.
Okay, thanks very much, Cynthia. That was a great demonstration. So we can take some of the questions perhaps that have come in. I see there's now a question from Gary. Has Recognia done any back testing on its pattern recognition signals or other trade signals? So that's a question I get very frequently. And of course, one of the challenges of being the vendor and also providing the back testing is people sometimes are a little bit suspicious. So what I like to do for that question is I like to quote some third-party independent information on this topic. So there's a fairly famous technical analyst named Martin Pring who did an extensive survey of classic patterns and their ability to forecast future price movements. And he actually published his research as part of one of his books called Martin Pring on Price Patterns. I believe it's chapter 18 of that book. But he actually looked at over 5,000 patterns occurring over a number of years, cyclical bull markets, cyclical bear markets, and so on, and looking at the effectiveness of those patterns. And I'll summarize very succinctly that basically his results showed that if you were to wait up to 5 pattern durations, that about 70% of classic patterns tended to hit their price targets, and a very significant percentage of those tended to be fairly big winners. So you can read the specific results for yourself, but there have actually been a number of studies that have looked at the effectiveness of patterns to forecast future price movements. Another question from Vivek, is Recognia available for Asian regions also, specifically for the National Stock Exchange of India? The answer is yes, so we cover all exchanges worldwide. The subscriptions in the Interactive Brokers site are broken up by region, so you're going to have to make sure you select the Asian region or the global region if you want to get access to our analysis for India. I'm just looking back for some more questions. I think that's all the questions that actually came in as part of the chat. But if you just want to pass me back the ball for a second, Cynthia, I'd like to just show one other thing quickly. I just wanted to show you very quickly here. I'm going to go to share my screen. So you should hopefully all see my screen. I have the Trader Workstation opened up at this point. And I'll just open up a new window. Perfect. I can open up a new news window, and I'll use the filtered news feed like Cynthia showed. And I'll just maximize that. So hopefully you can all see that. So again, I'm going to go into the configurations, and I'm going to ask for only Recognia news as part of this. Recognia Technical Insight. I'll say OK. So here are all the Recognia news stories, and that should actually fill out in just a second. Now what I wanted to show you here was, I think I've done something wrong. I should be seeing much more than that.
Peter, what I'm seeing is a message down at the bottom. We might have a bit of latency here. It does appear to be loading.
Okay.
So let's give it a try again.
Try that a second. Yeah, please wait loading.
Yeah, and would you go back to the configuration wrench? Let's give that a try and click Apply. Go down to the bottom where it is, click Apply and then OK. Sometimes that's what's necessary in order to bring it back.
Well, anyway, let's try something different. Let's try company specific here. So one thing I can try here, let's try for a specific company. Let's suppose we'll do for Google, or Alphabet, I guess we call it now. And again, we should have more than this as part of this window. Okay, so something's not quite working right now, but I guess what I was going to show you was if you click on any one of these, we actually open up another window, which actually shows you more detail about the event. So that's something you can also look at, and we'll actually provide you in that window with things like target prices. So if it's a classic pattern, for example, where we talked about how we derive a target price, well, we can actually derive that and show it to you as part of that window as well. Go back and see if we have any other questions. So can Recognia be tailored to use with ETFs? So the answer to that is yes, it can be. The Recognia analysis works for every publicly traded stock and ETF. So if you're an ETF trader and you're looking for analysis on ETFs, absolutely you can do that. Bring up the filtered window, filter for Recognia, and then you can actually put in the search. You can actually put in the symbol of the ETF you're looking for, FAS for example, and you'll see our analysis on those ETFs.